So let's talk about avoiding dividend traps. I don't think we've talked about this.
Never.
What's a trap?
Yeah.
Especially with dividends.
Yeah. So a dividend's great until it's not there.
Right.
Right.
Until it gets cut,
Until,
disappears, all those things.
bad stuff can happen.
Yeah.
So before we jump in, subscribe. We always want to.
You're a little
getting
direct.
better. I'm getting better.
Not even beating around the bush on that one.
Subscribe.
Just subscribe.
All right. So what is a dividend trap?
Really, it's going to be what we just talked about. You get caught with these shiny things that we refer to them as, but usually how it looks for us is the dividend that's paying that really high yield. You're saying, oh, if I invest in this company, this stock, they're going to give me a 10% or 15% return on my money as the dividend, that percentage. And it's like, ooh, this has to be the one to buy.
Yeah. And you go after it, and then you're relying on it, and then it may not be there. And we joke that we do bring this up a few times, but yet we still have people asking us, should we go for that? I still get a few stocks. People are right. I'm like, hold on. And it's because it's so hard not to go after the percentage.
I think the reality is when you become a dividend investor, you're like, ooh, this is awesome. And then you become a comfortable dividend investor and you think all dividends are created equal. And then you're like, hey, why would I want this dividend that's paying 5% or 6% when I can get this one that's paying 11% or 12%?
That's right.
And that's where the created equal part comes in. And you get complacent. And I don't mean that in a bad sense. I just mean like you get confident, like, hey, I've been in this for a long time. It's paid me well. It's done really well. Let's just ratchet up that yield and let's just go chase something a little bit more, because I'm sure they're all just the same.
Right. Dividend is a dividend is a dividend. Right.
Yeah.
Well, especially whenever you're in that phase where you're like looking in the refinement aspect of your dividend portfolio, no one's going to opt to reduce their dividend yield. So of course you want to look for ways to grow it and create more income. So naturally, probably the human instinct, even as asset managers, is like, let's go take a peek at those that are paying a high yield. Is there anything there? Mm-hmm. Sometimes, maybe, a lot of times, not the type of things that you want to be investing in.
So let's talk about why dividend cuts are so painful. Okay, right out of the gate, obviously you get the loss of income. And, I would say
you said it.
Was that?
I was like, oh, why we're going there?
Yeah.
Like I felt the tension that
immediately.
Yeah.
Well, I think it's a triple whammy, because we're talking about two big things, which are the most obvious. It's the cut of the income and it's the drop of the stock, because nobody cuts a dividend and the stock just goes straight up. Right?
Oh, well done.
Yeah, that's awesome. You must be doing great. I'm sure you did that for strategic reasons. But I think the most unspoken part would probably be the emotional impact.
Oh, yeah.
Because it's like you have this excitement of like, hey, this stock did this, or this stock is paying 10% or whatever the yield is, like, this is great. You buy it, and then 6 months later, you get slapped in the face with loss of income, 50%, 60%, whatever it is, and the stock goes down, and then your hopes get crushed. And now, even worse, you're doubting dividends.
You're doubting it all.
dividends.
Yeah.
What else is going to get cut? What did I miss in this one? Did I miss it in another one?
Right.
Like the sky starts falling a little bit,
Panic.
which is, you have that panic. But that's also why you don't just put all of your money in one dividend paying stock as well.
Right.
Like there's some of that, like take a deep breath, evaluate all the other
And how do
holdings.
you think about, I remember my grandpa when he was such a fun guy. And I remember when I was young and I learned that he doesn't eat Chinese food, and he has passed. And I asked my dad, I'm like, why doesn't grandpa, like, it's so good? And I was like, because it was the war, because he fought in the war, in World War II. And my dad was like, no. And I was like, oh, well, I thought that would have been an easy connection, right? He's like, no, he got Chinese food when he was like 21 and it made his stomach upset, never ate it again. And I know so many people that have had experiences like that where like they ate X, like I won't eat mayonnaise, like straight up mayonnaise on a sandwich. Because when I was little, I was super poor. And one of my friends' families, they made mayonnaise sandwiches.
No, guilty. Grew up on that.
And I grew up on that as well.
Guys?
And I ate it and I puked my guts up.
Oh,
Oh, wow.
And the bread was nasty. I was like, it was just mayonnaise and bread.
Sorry, hopefully nobody's eating while they're watching this.
And to this day, I can't eat. I can eat like macaroni style. I can eat stuff with mayonnaise in it. But if it's a flavor of mayonnaise, I'll throw up.
Right.
You're about to right
Yes,
now.
just
Your
thinking
mouth's
about it.
watering.
Starting to water a
But
little.
we are these types of people that we all have these idiosyncrasies, these aspects, and this can happen. You chase the wrong dividend, and now all of a sudden you're like, I'm out. I'm not doing dividends anymore. And all it was an emotional reaction to chasing something that you probably didn't need, but you wanted because you believed it was better. And now all of a sudden you've ruined it for everything.
We talk to clients all the time. Like that is their investment. Like, oh, I invested in that company or that type of fund or whatever. I'm not doing that ever again. So I'm going over here to this other type of investment. You know, mutual funds and stocks have burned me. So I'm only going to do annuities and bonds or something safer. You know, it is interesting how one bad situation and we're out.
So let's just talk about the most common dividend traps. Let's go through these. Let's talk about, there's 5 of them. What do we got? Unsustainable high yield. How do you know it's unsustainable? Probably because it's really high.
Yes. And you go look at that balance sheet. You look at the cash
look at the
on
company's
hand.
health.
Yep. Look at some debt. Like, oh, wow. They can't pay that very long.
So major red flags here, unsustainable high. And I'd probably say you're creeping into that territory once you get over probably 7%. You know, 7 and below, even 7, in this environment, I'm a little nervous about it, but I'll say above 7, you're there.
Yeah, you need
but
to
7 and below,
you need to really evaluate. Yep.
Once you get above 7, I'd start having the lights go off. Payout ratio. A payout ratio is what?
That's your earnings versus your cash flow. So you're really looking, all right, how much is being paid out versus what's coming in, right?
Yeah.
So if that starts getting really out of whack and what they're actually paying out as their dividend payment is far greater than what they're bringing in on cash, there's another major.
And there's an asterisk. There's an asterisk on all of this, but there's definitely an asterisk on payout ratio because you have to get into the details of why it's high. If you see it like 170%, why is it 170%?
Yeah.
Well, they did X, Y, and Z in their company. They bought back debt or they did whatever. And all of a sudden their cash flow just got crushed and now their payout ratio looks super high. But in reality, they did some very strategic good things and it's a short-term deal. Yeah. So payout ratio is something that you probably want to look back more than just current. Probably want to look back a year, 2, 3 years to see where that's at. And if it just all of a sudden spiked, they probably did something at the end of the year or their end fiscal year it blew up their books, but it was really good. And it's about to come back down.
Yeah, you see it a lot through whenever companies will buy another company, or they go, or the inverse, they sell off something, and then they have all this free cash flow. Yes. Yeah, and it's like, whoa, these guys could pay for a really long time. It's like, hold on though, they're probably getting ready to deploy a lot of that cash
or buy real estate or whatever. So weak or declining cash flow, free cash flow is like my favorite thing to talk about. We talk about that all the time.
Yep,
that is one huge indicator. Poor balance sheet health.
I like looking at that one because if they've got a ton of debt already on the books and it's short term, you're probably in trouble.
And here's where we've been burned personally. You look at their balance sheet, you look at their cash flow, you look at their payout ratio, you look at all of these things, and you're like, hey, we're good. They have no issues for at least 2 to 3 years. Well, companies typically don't wait.
Yeah.
They kind of get ahead of the game, and it's almost this cat and mouse situation where like we can hang on for a little bit, and then all of a sudden we get blindsided. We saw it coming.
Right.
But we were a little...
We thought that they may wait a little bit longer to address it or would address it in a different way.
Because you can see the writing on the wall. I mean, all of this stuff, most of the time, the writing's on the wall long before you see it. There should be no shocks. And there hasn't been really a shock other than a pandemic or something like that. You know, most of the time, or a bad CEO that they're cooking their books. I mean, there's certain situations where you can't see coming. But for the most part, you can see most of this. And the ones that we've been caught on, we were just being a little bit either too passive or too patient.
Oh, yeah, I would say too patient.
Yeah.
And maybe just a little bit hopeful.
Then they come out of it.
Yeah.
Actually, that's a good
whatever,
one.
Cal. We were just being patient. Just kidding.
Let's spin that around.
Yeah, controlling the narrative, which is,
No, totally. There is. You want to think that the companies that you've picked
They've served us well for a while.
Well, and you've done your due diligence to even put them part of your portfolio.
Yeah.
So you really want to believe in the ones that are there. You want to, it's Aaron Rodgers hanging on a little too long, or
boy.
even my favorite quarterback, Peyton Manning. Hey,
We'll get
wasn't
started on
him.
that. Oh, I know.
They
Sorry.
won. They won their division.
They did.
They did. You're right.
They did.
So let's talk about how
Exactly.
to.
Let's see how far that goes.
Let's talk
Steelers
about
did.
how
Like the
to.
high yield.
Let's talk about how to stress. We should do football and dividends. One show.
Football analogies
Yeah.
to dividend. Yeah.
How to stress that. We're gonna do that for the Super Bowl.
And it'll
I think
matter
we should do that for the
emotions.
Super Bowl.
It'll matter based on emotions. So did your team win yesterday or did your team lose? On how bold you're going to be and how confident you're going to be. That could be an
We are
interesting one.
doing that.
Let's
do
do it.
It's gonna be a fired up show.
Yeah.
Especially the way the rankings work.
And you know
'cause
what?
this-
And you got to bring your
Niners-
team and make an analogy to your team, the goods and the bads.
Perfect.
Can we
Because
do
the
it
Niners
based on
just
last
go
year's
bump to a
performance?
6. Yes.
That'd be so fun. So stay tuned.
Stay tuned.
All right.
You don't subscribe.
How do we stress test the dividends before you buy? What are some things we can do?
So when we just talked about really looking at that cash flow
Yep.
and how much free cash flow they have on their books, it's a great indicator because, hey, if this company doesn't turn a profit or if there's some type of recession or pullback, can they still pay their dividend or do they actually have to have revenue to pay that dividend?
Do they have an emergency fund like
Yes.
we should all have?
Cash
Does the
fund.
company have an emergency fund to help them if cash becomes
Yep.
a challenge?
I love it.
And just history too. I would just add like the history of the dividends. Is this crazy rock and roll, or is this steady increase, or at least flat and then a little bit of a tick up? Because how many times have we seen something where it's just like boom, and then all of a sudden it crashes, and you're like, oh, okay.
Yeah. There are a multitude of dividend payers. It's those dividend growers that are really the ones you want to look at because the dividend payers, they're basically treating a dividend as like a profit share.
Mhm.
You know, hey, the company did well, we can pay X out this year. And next year it's a little different and there's no consistency. They're just saying, hey, we had some extra profit. Here you go.
Right.
Those are the ones you don't want to build your retirement on.
Yeah. So, and I would say be a long-term dividend investor. Like, don't think just now. I think at the end of the day, you know, we've given a lot of things that we can talk about. Some things that we didn't, like what's their industry, how do they compete? You know, we know their cash flow and all the things that we've also talked about. But when you look at things for like a year versus look at things for 10 years, you think differently.
Oh, yeah.
So when you go to buy a stock, I would say, let's look at the next 10-year time horizon. Do we feel confident we can hold this for 10 years or do we feel confident we can hold it for 2? I think that mindset right out of the gate is going to probably get you past 90% of the problems because you're like, I'm not sure. If we did that on every single one of our stocks, we'd probably blow out of some of the ones that we're hoping to fly. But at the end of the day, we have a portfolio where it's like 85, 90% very solid. And we do put some flyers in there on purpose.
Yep.
Right.
You know, but for the most part, for your core, you got to think long term.
I mean, think with the Buffett mindset to never sell.
Yeah.
If you go into it as, would I invest in this company for the next 40 years? Then that's where you want to be.
And if you are going to get crazy and go after, chase something, make sure you've got the ones that are tried and true and have gotten you there and you've got your income for retirement solved for. Yeah. And then if you want to go chase some shiny things for fun because it's extra cash, okay, fine. But make sure you got yourself set up before you go and chase shiny things.
So,
I mean, look at you.
Yeah.
Making sure you're on budgets and emergency
it's a
funds.
big deal. If you want to go have fun because you do have some
Serious
people.
Nikki today.
It's like you got to spend a little bit of your money or you're not going to want to go to work every day. Like if you really like to go and try, let's just see. But make sure you can pay the bills first, now and in the future.
Can't spend money, you're never.
Damn, I think we're done.
Yep.
I'm sorry. I had my closing comment.
Yeah.
Drop the mic.
Drop the mic.
I'm just teasing.
One more thing. If you want to learn a little bit more about dividends, go check out our dividend starter kit. Just put in the comments. You got to subscribe first. But once you're in the comments, just put dividend starter kit. We'll send that right out to you. And make sure, what was that?
That you have planned for now and in the future before you chase shiny yields. Shiny percent yields.
All right.
We're done.
There we go. Works for me.